This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Today we are joined by Wes Gray, who is the CEO of Alpha Architect, which is a firm in the US that's doing concentrated quant factor strategies.
Wow, strap on for this one.
Yeah, Wes is he's a serious guy. Just talking to Cameron before we started recording this, he's got a very self-deprecating demeanor about him, but he graduated magna cum laude from Wharton at the University of Pennsylvania, which is, as people probably recognize, a pretty serious school. But then he also did his MBA and PhD from the University of Chicago, which is like, people don't know, in the world of finance, Chicago is like Harvard. Like it's the place. In terms of reputation, that is the place to go. So, I mean, he's self-deprecating, and you'll hear it when he talks, but he's a very, very, very smart person.
He even took a pause in his PhD, which he was doing with Professor Fama, Nobel laureate Fama, and joined the Marines, went overseas for 4 years, and even became embedded with the soldiers in Iraq. It was incredible.
Yeah, he wrote a book about his experience there. He's written a bunch of books.
Learned Arabic, too, when he was in Japan before going to Iraq.
Yeah.
Anyways, he came back to Chicago, finished his MBA and his PhD in finance.
Taught at Drexel for a bit, which is where he met one of the people that he works very closely with, Alpha Architect. That was where he kind of got, and we talked about this in the podcast, but he made this transition from being sort of a value investor, stock picker, to having this hardcore quant focus and realizing that you could eliminate all of the human biases, but still capture the factor premiums. It's kind of like taking what someone like Buffett or Joel Greenblatt does with value stocks and automating it, making it a quantitative process as opposed to a human process. But
what an eclectic, interesting guy. And if you follow him on Twitter, you'll see he's a extreme distance runner, does all kinds of interesting things, his Marine background, and extremely, he's brilliant, rules-based, but he's out there in terms of personality and very self-deprecating. As we said earlier, you couldn't have a fight with him. He's just so nice and sees all kinds of different points of view, but really brought out the nuance of investing and how you have to make sure that the portfolio matches what you're really after. And as we learned from Ted Seide's interview recently, the world isn't black and white necessarily. It's a much more nuanced look at things.
Yeah, the nuance is amazing. And the nuance on factor investing, the nuance on behavior versus risk-based factor premiums, on active management versus passive and indexing, factor investing is a very, very good conversation. This post will be up on the rationalreminder.ca website. So if you have comments or questions about the episode, head over there and post a comment. And Wes also graciously said, well, his email address is pretty easy to find online, but if you have questions for him, he said he'll answer your email, is what he said.
He certainly did. So with that, enjoy our conversation with Wes Gray.
Wes, welcome to the Rational Reminder Podcast. I can't tell you how excited we are for this conversation.
Hey, excited to be here and appreciate the invite.
So your story's fascinating. And if you could start, because I love this part, can you tell us about your experience as a stock picker?
Sure. Kind of a lot of ups and downs, but so I kind of started investing old school Ben Graham, intelligent investor, Bible thumping value stock picker guy. And I literally did that when I was like 18, when I could officially really do it. And the problem with me on stock picking is the first stock I bought with any sort of scale was this thing called Swisher Sweet cigars, like super crappy cigars. I don't know if you guys ever smoked them, but I bought this thing at like $6. It was like, deep value, huge return on capital, huge return on equity, like kind of like even a Buffett stock. And I think it was like 2 or 3 months later, it went from 6 and it got bought out, I think, for Philip Morris for like $10 or something. And the reason I say it was like a terrible experience is I made a bunch of money, but then I was like, oh, this is easy, man. Like, why doesn't everyone just be a stock picker, buy value? So that was kind of like my intro. And that was also right around like the internet bubble time when everyone was making money. So I had that one good pick, but then obviously because I was doing value stuff, all my other picks weren't doing anything. And then I got, confirmation bias, like, well, all these internet people are crazy. They don't know how to make money. They're just buying overvalued stuff. And so I just kept doing kind of the net where you'd buy companies for less than working capital. I'd look at like liquidations where there'd be some stub stock where, the liquidation value was like $1 and selling for 80 cents. And there was an actual active liquidation going on. And so I was just trafficking in like under 50 mil total trash, deep value stocks. And I did that for a long time. And that was obviously a good time to be doing it. Kind of that 98, it was probably around 2004 until I joined the service in. But as you guys know, small cap value, that run from probably around 2000 to 2004 was epic. And at the time, I wasn't really quant, so I didn't really understand like how factors work. I was a stock picker that just happened to be in a wave of like, small cap value, whooping it on. So my Swisher Sweet thing went well, had a dry run there with the internet bubble, but then obviously had some monster wins, where I'd make 100% return on these little stupid value stocks. And I just, I thought I was a genius. I did that all through like the first 2 years of the PhD program there as well, which I started in 2002, and then kept stock picking basically till around 2004, which is when I left to join the service and was gone for about 4 years or so.
So this leads right into a question about your PhD dissertation, which was at the University of Chicago. And to me, as I understand it, it was about proving that value investors have stock picking skills. And in fact, your advisor was none other than the recent Nobel laureate, Professor Eugene Fama.
Yeah.
Can you talk about that experience, at Chicago and with Professor Fama?
Yeah. So one of the things like on backgrounds on these PhDs is, you've been having PhDs hammer on the CRISP data set, which is kind of like the price data set that all academics use. And so everyone and their grandmother's been hacking on that thing for 50 years. So it's essentially the only way you're ever going to get a dissertation done these days is you got to go find your own data source, and kind of build up your own story. And then one of the things I had been doing as a stock picker is I was part of this thing called Value Investors Club, where it's like this invite only thing. You got to apply. It's like Stock Pickers Anonymous, set up by this guy named Joel Greenblatt. And, I've been on that thing for years, and I read every single pitch because I was contributing pitches and I'd read everyone's pitches. And I was like, man, these people see, like, of all people who are stock picking, these individual hedge fund types seem to have some value add. So I was like, you know what? One of the things I like to test is let's actually see if this is, a systematic effect. Like, does anyone actually have stock picking skills? And so literally I read, I think there's like 4,000 of these stock pitches, databased them up, did all the analysis, you got to do all the factor regression, see if they have alpha, blah, blah, blah. And, I got Fama to sign off on it. So, and obviously he made me confine the language to, yes, this is true, but it's for your sample. It's not an equilibrium effect. Not everyone can beat the market forever. But, it was so like, it was my little win against the fish and mark hypothesis founder. And thought it was fun.
That does sound fun or terrifying, depending on who you are, I guess.
Yeah. Well, you got to remember, like, so I entered the program in 2002. And then in those PhD programs, the first 2 years, it's just, you're just getting beat down on tests and like, typical academic work. And then I left for 4 years. It was in the service. And then when I came back in 2008, I'd been to war, I'd been to combat. Like maybe I was probably overconfident and I just wasn't afraid of Professor Fama, to be frank. Eventually I became more afraid, but I was almost just too dumb and too overconfident. So, I was just like, what the hell? Like, I'm going to do exactly what you probably shouldn't do on a dissertation, just because at the time I was probably a little overzealous. But that's why I think I was able to do that, because obviously most PhD students are probably not going to go down that path.
Yeah, I mean, that moment of overconfidence is a huge part of your story, so it's pretty cool.
Yeah, unfortunately, it's been good and it's been bad. Because I'll tell you another one, because I think you got another question about like, how the heck did I go from being a stock picker to a quant? Well, it's very easy. So I'd done all this, I've been doing the stock picking thing, and then finally I got convinced like, hey, maybe this whole quant thing is probably a good idea, because it seems like a lot more efficient way to invest than like having to do all this work. And so literally I launched a fund in September 2008 which you guys probably remember is like the worst time ever to start up a hedge fund. And it was literally like a quant, like deep value quant model alongside. And then it would just short like R2K futures because I was doing small value, but it's supposed to be kind of market neutral. So I launched this fund and literally I got my short future, or sorry, my short, I was using cash, not futures. It got called in. And so I couldn't be short anymore because at the time, people would think that'd be impossible if you tell them that, oh yeah, right. Like R2K could never be called in on short, but guess what? It happened. And so I couldn't even be a hedge fund anymore. So I was like, okay, now I'm long only. And then of course, again, being overconfident, being an idiot, I had this quant model, was going to eliminate all my biases. Now I have to be long only. And now I'm seeing all these nets and all this chaos. And I'm like, oh my God, this is the best opportunity ever to be a stock picker again. And so I literally talked to the LPs and I was like, guys, we need to ditch the quant model and go back to stock picking, man. This reminds me of like 2001, 2002. And of course I did this and it, had a few good wins, but then I had a few like just insane losses. And in the end, like after it was like 2008, 2010, I essentially was R2K with like twice the vol and about 10 times the stress. And of course, if I just stuck with the damn quant model, I would have beat the R2K and me and not had all the stress. So that was kind of like for me, man. I was like, you know what? I'm done. I'm not doing stock picking anymore. And kind of ever since then, I've been just pure systematic. I don't do it anymore.
Just for our listeners, the R2K is the Russell 2000 US small cap index.
Yeah. Yep. Yeah. Russell 2000.
You touched on it briefly just now, but can you talk a little bit more about the importance of biases when you made that switch from being a human stock picker, obviously with biases, to quant? How did you realize that you had to eliminate the biases?
Again, this is a personal thing because there definitely are stock pickers, and I know a few who they're just machines or robots, and for whatever reason, they have way better capability to kind of harness and manage these problems. And I used to think I could do that too. But for me, it was just eating like tons of humble pie. So I kind of did, if you guys know like the Warren Buffett story, there's stories about him like putting like 70% of his capital in Geico. And obviously that ended up being a good thing. And he's, a multi-bajillionaire. And I ended up doing a similar thing where I had this super concentrated portfolio, these like uber small, like net liquidation deals. And on one of them in particular, which ended up being a fraud and like a total bust, I think I got it up to like 60% of the capital in there because I'd done so much work. And when you do so much analysis, what happens, and now of course I read all the psych studies that say I was just succumbing to all the problems. But as you read more and more information, your confidence goes up, but a lot of times your forecasting ability of like predicting doesn't really move. Like, you need the first few pieces of information to kind of get you in the right ballpark of reality. But then what happens as a stock picker like me is you get so obsessed and you read everything, you do all this work, you spend all this time, and you just keep getting more and more confident in your decision. And you end up doing stupid things like I did, where I had like 60% of my portfolio in one penny stock, and which after the fact obviously seems stupid, but I actually did that. And I think it was just because, I was falling prey to all the standard problems. And I realized through experience and after getting my ass handed to me that I just need rules, man, because there's no amount of, convincing yourself when you're in the fight that you're not suffering from overconfidence. You're not, believing your own story. So you just need rules. At least I did. So for me, that's very important, but other people are different.
So let's talk about those rules and how you brought those rules to being at your firm, Alpha Architect. And can you talk about how those rules impact how you're now building portfolios?
So I always came into like the quant world, like the academic world, from a stock picker mentality. And so, you do like the sorts on portfolios, like even like book to market or whatever PE ratio. And you always say like, wow, if I just hold like the top decile of cheap stocks, this seems like a pretty great strategy and just, works. It's got super high expected returns. Obviously it's totally insane with a lot of tracking error and it, moves all over like the general benchmarks. But at the time I was just focused on trying to make money, for my own personal dough. And I just thought that was super interesting. I could, build these portfolios, just do simple decile sorts, like go on French's website. Anyone can verify this. I was like, hey, it makes sense to me is if I'm going to quantify some concept like buy cheap stuff, i.e. the value anomaly, I'll just buy the top decile and own them because that seems to be where all the mojo is. And so that's kind of when we set up our firm because I hadn't been ever really in the business of asset management. So I was not thinking about, tracking error, like constraining and, all this stuff. It just never even crossed my mind because I'd never been in that world. So we just always start our portfolios like, hey, if I want to capture the value premium, what is like the best way to do this? Without even considering all these other things out there in like, institutional constraint world. So all of our portfolios, we end up just moving towards what we call them like focus factors. But the idea is we just want to be amped up in the particular characteristic we want as much as possible. And yeah, it's going to have like tons of idiosyncratic volatility and what have you. But the idea is, presumably you're going to pool these things together or you're going to use them on top of, whatever, your Vanguard funds. So a lot of that will kind of wash out, but you still get a access like the higher expected, returns associated with being in super concentrated factors. So that's how we kind of started, mainly because we never got brainwashed, by being in the real world, where now I know after the fact that had I gone to like a normal place, we would probably never came around to this idea because we just wouldn't have been thinking like that. So that's what we do, concentrated factor portfolios, basically.
So our listeners are at least somewhat familiar with dimensional fund advisors because we talk about how they think quite often. Can you talk a little bit about how because you mentioned factor investing and higher expected returns, and I think our listeners are familiar with that type of language. Can you compare Alpha Architect to dimensional?
Sure. Yeah. So we actually model a lot off of dimensional. So first I'll tell you where the areas that I really respect those guys and gals. Marlene Lee's one of my old Chicago mates, but I mean guys just broadly. But DFA and AQR, like one of the things that really resonated with me with both those firms is just, focus on like education. And it was almost like they're academics that are just doing investing, which that kind of made sense to me and resonated with me. And I just like hey, this is not proprietary. This is, transparent. You can go redo the results yourself. Here's our model. And obviously sometimes they hide a few things here or there, but the big muscle movement is transparency and education and, evidence-based. So we obviously resonate with those two firms on those points, 100%. But the other thing is you can't just say, hey, I'm going to go in the business and redo DFA or redo AQR, and they're monsters. And I'm like, do I really want to be managing like hundreds of billions of dollars and, managing thousands of people? Not really. I used to be in the Marines and I like managing small teams. I don't like managing people problems. So I was like, well, what can we do that's kind of like that in spirit, but differentiated? And so what we do is, again, we just do the kind of more focused factor versions where, yeah, they have way less capacity. Like, DFA's got whatever, $700 billion. If you said, hey, Wes, here's $700 billion, obviously we would not be doing the kind of strategies we're doing because we couldn't. We just got too much money. But we're a boutique, and I kind of like that. So we have the luxury, I guess, of because we don't have billions upon billions of dollars, we can do these more concentrated, smaller portfolios without having to worry about, crazy market impact problems or just functionally not being able to do these strategies. So that's really a difference. We're just much more concentrated in our factor approach, where they're more what people call like closet indexing or lower active share, which is fine. It just serves a different purpose, but we're just different in that regard.
Yeah, it's a great way to describe it. It's just the difference in the concentration of the factor bet.
Yeah, exactly. And there's just trade-offs. Like obviously if you do more concentrated, it's going to be more crazy. If you do less concentrated and it's more molded to look like a market index, it's going to be less crazy. And that's just the trade-off that people have to, deal with.
So can you talk about that trade-off, Wes? Because we talk a lot about, and I always say that one of Ben's favorite words is reliability. So by going more concentrated, how do you view the impact on reliability of capturing that higher expected return from, especially the value factor?
Yeah. So essentially, there's a trade-off, right? If you believe in like the risk-based story that say like a DFA tells, which actually I believe in too, at least in part, and that story is essentially, hey, the more you own cheap, because cheap is generally a proxy for risk, the higher the expected return you get. Okay, great. But then you have two dimensions. Well, I could do a portfolio that owns like a super diversified basket of, say, whatever, the top 500 cheapest or something, right? And yes, that thing is going to be, because it's got so many more holdings, it's going to quote unquote be more reliable and have a lower dispersion of possible outcomes, right? Like at least relative to like whatever S&P 500. However, the other thing is, well, if I believe in the risk-based hypothesis, like, well, if the top 500 are good, imagine the expected return profile of the top 50 or the top 100. Like if you believe in the risk-based hypothesis, well, then the more you amp up in that characteristic that proxies for risk, the more risk you're presumably buying, and therefore the higher the expected returns you're getting. Now, so as you get more focused, your expected returns mechanically, in theory and empirically, should go up. However, because those are more concentrated portfolios, obviously the distribution of outcomes is going to be wider. And so then it's really a question of, well, I could go for lower expected return, tighter distribution outcome, or I could go for higher expected return, wider distribution outcomes. And then it's really just, an understanding of like, what do those histograms or distributions look like? And am I willing to take on, essentially, do I want to get higher expected returns but take on higher distribution outcomes, or do I want to get more, lower expected return, relative returns, and get tighter distributions? So it's just a trade-off, I'd say.
So that the reason that we always talk about reliability is we're generally speaking to sort of mass affluent clients who have, they're wealthy, but they don't have so much wealth that they're never at risk of running out of money, like a regular wealthy family, not an ultra wealthy family, maybe. And for them, I think reliability is super important.
To be clear on that, it's the reliability, depending on who you're talking to, is really about relativeness reliability. So it's about how you reliably beat the market. For example, like really this is the trade-off. So I could build you a system that's super low tracking error, and this is fake, but I'd make a system that beats the index by 50 bips a year highly reliably. I could build another system that beats the market over like a huge cycle by, I'll make it up, 5% a year, but it's unreliable as hell. So your in-state long-term growth rate is way better. But the question is, in the short run, like, do people want the thing that hits the single all the time? Or do you want the thing that will actually make you potentially rich, but it has these relative underperformance? It's not like it goes to zero. It's just that on a relative basis to some baseline S&P 500 or whatever, you look like an idiot a lot of the times, which is a key differentiation, because there's the risk, there's relative risk, benchmark risk, and then there's straight up, is this portfolio going to go to zero, or does it have a drawdown profile that it goes down 100% when the market goes down 60 or 70? That's like absolute risk. And those are two things that confuse people a lot of time when people talk about these factors in portfolio construction.
So when we're talking about this concentrated structure and the wider distribution of outcomes like we were just talking about, that you think about your ideal client differently than a firm like Dimensional, or maybe a firm like us where we're dealing with people's retirement money? How do you think about your ideal client?
Yeah. So, I mean, in general, like our ideal client is it's like everyone wants Warren Buffett's, right? So we want people that are highly skeptical, willing to learn, been humbled, so at least they're open to the idea of like doing quant systematic, and they realize there's not some like magic genie stock picker out there. And these people have super long horizon. They understand the rat race of trying to beat the index every quarter. They know that's a loser's game. It's the long horizon, permanent capital, super sophisticated investor. Like, we love those people, but obviously everyone loves those people. And it's like finding a diamond out there, right? And that's fine. But then the other type of client is really like the financial engineering client. Because we always say, listen, in the end, you got this cake. It's got a lot of market and it's got a little bit of whatever you want, like this value factor, let's just say, right? And then, there's different measures out there. Tracking error, like active share is a pretty intuitive one, where it's saying, hey, is this cake 95% just the Vanguard fund and 5% of what you want? Or is this cake 100% of what you want and not much Vanguard fund? And so what you can do is, as someone who's a user of different products, you could, for example, say, hey, Wes, you guys got this maniac fund that's like so doped up in value. Yeah, I'm not doing 100% of that, but I only need 10% of that. I can bolt that onto a Vanguard fund, and I've now replicated like the closet indexing version of value for like half the cost, because I've financially engineered the same thing, but at lower cost, because I've broken out the pieces into, the pure activeness and like the closet index kind of market beta piece. So in theory, our stuff can be used by sophisticated users to a lot of times replicate other things cheaper and or just add diversification to, whatever their version of the factor is already doing. So in theory, it could be used wider spread to many clients, but obviously needs to be sized much differently. And the person who's baking that cake for the client obviously has to be pretty sophisticated in how they form the portfolios and what have you.
So is this how you think people should look at all the different quant shops that are out there? Pick something, I'm generally speaking here, pick something that's diversified, broad-based, like Vanguard or Dimensional or whoever, and then go and select what you call the doped up options on top of that. Like, how do you view this whole quant world for the retail investor?
Yeah, I mean, I think for the retail investor, like the market's kind of moving towards this barbell where you got super scale kind of closet index market beta-ish stuff, like maybe has a little bit of tracking error on some factor. And then you got the boutiques who are doing, non-scalable, super weird niche stuff. And yeah, they're not getting huge allocations. And then you got the middle road. So you've either got like super cheap, super efficient, monster scale product, and then you've got super boutique, super niche weirdos. And anyone in the middle is kind of screwed because what are they doing? Like, they can't compete on the scale guys on price. They can't compete on the boutiques because, they're not as focused. And so I think the world in general, at least down in the States, you're kind of seeing this like barbell of Vanguards and iShares.
Who's in the middle? The active mutual funds are in the middle? Is that who's in the middle ground?
The active mutual funds that aren't actually doing anything different, i.e. like people that have super low active share, or their inherent kind of closet indexes. Down here, those people are getting smoked out of the business very quickly because people are now like, hey, wait a second. This is basically an overlay chart on the S&P 500. Why am I paying you all these fees, to do this different stuff when you're really not different at all? Like, I'd rather just take that fee bucket, put most of it over here in like Vanguard or iShares or whatever, and then I'll save, for my active bets on factors or stock pickers, what have you. I'll go allocate that to people who are actually doing stuff that's highly differentiated and presumably unique. And also hopefully affordable, tax efficient, blah, blah, blah. So I think that's where the market seems to be going down here, where, like you said, you have kind of like these core portfolios of like very cheap, very broad-based. And then to the extent that, the client has the behavior to handle it because they can deal with tracking error, and the user knows how to do it, or they want to take a bet on value or momentum or whatever, they can then start peppering those in as kind of satellites to, fill a client's specific goals or needs or what have you.
So how do you think about, like, you have quant models that you've been involved with developing from an academic perspective. And I know you have Jack Vogel, who's like a super data guy, and he's helping you build those models. But there are other shops that are building models. So if I'm an investor or a portfolio manager or whatever, and I want to add that doped up value premium or whatever, how do I choose who's got the best quant model?
Yeah, I mean, honestly, one of the things that we've learned over time is there's really no such thing as best. It's about, understanding the transparency of what the heck are these people doing and how does this fit in my process, or how does this help like clients achieve a particular goal. So I think the most important thing when you're dealing with quant shops is how transparent are they? Because you need to understand what they're doing, because you then need to explain to someone. And how focused on education and reality are they? Because all these models that are doing anything that's going to add quote unquote excess return, in like a back test or historical sense, well, the reality is that those things earn expected excess return because they probably suck. They're either higher risk or behaviorally very challenging to own. So it's not really about like how awesome your quant model is. It's about how reasonable is your quant model, and how much do you help us explain this to clients so they can actually sit and deal with this quant model. I think like the ability to help on the behavioral side to help people stay in their seats, which is not really pure quant, but kind of pure quant with a behavioral element, is what allows people to actually be successful. And so let me summarize. If I had a black box quant shop who doesn't tell me what the hell's going on, and they just say, hey, it's all proprietary, just trust me, even if it was free, I would not want to do that, because presumably whatever they're doing will have a bad streak. I'd much rather go to a shop that's like, hey, here's what we're doing. Here's a bunch of materials that outline why this works, why it stinks sometimes. When we're going through bad times, we'll help explain that to your clients so they don't blow out the exact wrong time. That actually has a lot more value than, say, this black box quant shop that, let's presume they had an even better quant model. Like, let's just assume that was true. I think you need the whole package these days.
That's really insightful commentary. We just had on a recent episode, Ted Seides, who worked for David Swenson at Yale.
Yeah.
And Ted told us that what David was so good at was having a set of beliefs and then being really, really good at communicating those beliefs to the stakeholders.
Yeah, it's huge. And you guys know it, being in the business, we've learned over time, we've always been like direct to consumer, in the sense that like we never had like distribution or whatever. So we always just put out research because that's just what we knew how to do. And so we've always been lucky to attract kind of these weirdo people that are into this stuff. But then over time, we started to attract kind of normal people who just find it cool or flashy. And those people were like, oh, wow, this is what the real world's like. And they're always asking you every month, like, why did you get beat by the S&P or whatever? So it's just, the real world, you need to have someone there that can help on, keeping people solid, sticking the seats and sticking with the mission, basically.
So speaking of flashy, what's your view on the hedge fund world and alternatives?
So my view on any investment is it boils down to what's the process, what's the cost, what's the tax efficiency, et cetera. So hedge funds in general and hedge fund strategies, I think, are great. Like, obviously they've all, stunk it up on like a return basis. But I think the idea of, market neutral, managed futures, like all these like super niche boutique-y true diversifiers are great if you can access them in a way that's affordable, tax efficient, and and understandable. But the real challenge, I think, that's always been with the hedge fund business and like the fancy schmancy deal is that conceptually it makes a lot of sense, right? It's in the theory. Pool a bunch of super diversified, unique exposures together. They all kind of cancel each other out on the risk, and you get like this nice expected return. The problem is that's the theory, but once we incorporate, the brain damage of understanding all this stuff, the crazy fees, the tax inefficiency, blah, 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 they've had a bad run. And until, the world or someone figures that out, it's, and this is where I kind of agree with DFA to some extent, like, is it really worth the brain damage of it? So I think it could be, but it's just, that's been a big challenge in the hedge fund industry, for the last future or the last history of how it's always been.
We kind of touched on this when we were talking about the reliability of outcomes, but if I look at like the quantitative value index, for example, it's got 41 holdings. At what point, or do you worry at all about idiosyncratic risk?
Yeah. So sure, for definitely we worry about it. And there's kind of two levels of thinking. There's at the individual portfolio level, and then there's at the level at like the higher portfolio level where a user would presumably incorporate this in to their broader diversified portfolio if they're doing like efficient frontier type thinking. But at the portfolio level, you guys know all like the diversification studies, like a lot of the idiosyncratic risk starts to bleed out very quickly. Once you buying one stock's probably crazy. Buying 5 is pretty crazy. 10, crazy. 20, 30, 40. You've kind of captured or you've eliminated a lot of like the baseline idiosyncratic risk at that point. And then, from 40 to 100 to 200 to 500, sure, you get marginal idiosyncratic risk benefits, but it's at an expense of higher expected returns. And so that's where there's this trade-off of like, hey, do we want to do our factor model on one stock? Probably not. Even though it may have amazing expected return, but maybe like 40, 50 to 100, that's a range where, we've eliminated a lot of like, if the CEO dies type problems, but we still get to have it amped up where you still got super, like in values case, like cheap characteristic and presumably higher expected return. And that's why we've kind of chosen those ranges around 40 to 50, basically.
Is there a level of assets that an individual should have where it makes sense to add more active risk to their portfolio?
This is a great question. And what I found through experience is it's not about level of assets. It's about level of education, willingness to learn. So I sit on, I'm not going to mention anything here, but I sit on boards of insanely rich people. And some of them are like the most sophisticated people on the planet Earth. Others, like, they don't get it. Like maybe they don't come at the world from like an investment standpoint. They may come at it from like a manufacturing business standpoint where everything's like, what's happening this second? What's the efficiency? And their mentality just makes them terrible investors, which means, hey, you should probably buy a Vanguard fund. And every day you can look at the Vanguard fund, match the S&P 500. Done. That's great. So I've noticed that the level of money you have a lot of times doesn't correlate perfectly with how good you are at dealing with and managing and understanding active risk type bets. So I'd say it's more about like the individual's willingness to be educated and their understanding of the trade-offs with active risk versus how much dough they have.
That makes sense. That's good insight. We talked earlier about the risk story for factor premiums, and you mentioned that you partially believe that, but the other part of your belief is that there's a big behavioral component. Now, we talked about this in the podcast quite a bit, where if factors are risk-based, persistence, you can be fairly confident that they're going to be persistent. But if you're taking the angle that there's a big behavioral component, how do you think about persistence?
Yes, so it's a great question. So there's obviously this huge debate in academic literature where people try to say, well, you earn excess return because it's riskier. And when they say risk, they mean like fundamental, like macroeconomic equilibrium risk. And they don't really consider something like career risk, which is a behaviorally driven thing because you don't want to do crazy stuff because your clients pull your money out. That's not really like a fundamental risk because it should be arbitraged away, right? So I just think of risk in general in the financial markets is just pain. In regard, like if you want to map the pain to fundamental risk, great, that's awesome. That's probably persistent. But you can also map the pain to the cost of arbitrage. Like you got to be insane to hold this portfolio and take on monster career risk. You got to do weird stuff that people don't like. Like this is also costly, but in a different way that may not be related to how the returns correlate with your consumption patterns or whatever. So I just say, hey, as long as there's identifiable pain, and that pain is something that out of sample we can continue to expect, I would say that that's fairly probably going to be pretty persistent. And so on the risk side, let's just break these into like the fundamental risk and what they call like behavioral risk. So on the fundamental risk, like that's pain. Taste could change. Like people might consider what, is like, they don't like, for example, like there's a lot of arguments now that the pain of owning idiosyncratic risk has gone down a lot because it's so easy to diversify globally and own every asset class on the world. So maybe if there was some sort of premium in there for taking on idiosyncratic risk, that's come down. So now just risk-based models where they used to earn really high expected returns because diversification is so cheap, maybe that premium's kind of come down over time. And so that'd be one area to think like, hey, out of sample, I want to understand risk, how it's priced. You could think about, well, is risk pricing changing over time? And on the behavioral side, usually there's a situation where there's some issue in the marketplace with behavior, like, people overreact or underreact, or they performance chase or what have you. And that would obviously be eliminated immediately if it was costless to arbitrage, right? But the issue is there's a lot of times limits of arbitrage because, for example, exploiting value as proud DFA holders and as a value investor myself, we all know it sucks to be a value investor when, the market goes up 20% a year and you're not doing anything. And so in order to exploit some of these premiums, even if they may be caused by like a behavioral issue, if it's costly to arbitrage it out, and it presumably is going to continue to be costly to arbitrage this out, these sort of premiums will probably also persist. And so that's how I kind of think out of sample. Like if I earned excess returns, it's probably an element of risk and then behavioral issues that are hard to arbitrage. To the extent that arbitrage is still costly and to the extent people still hate risky stuff, I can predict, from an economic standpoint, that I'll probably earn some sort of excess return. But the bottom line is it's going to be painful. And if it's not painful, then it probably won't exist out of sample. And so that's kind of the framework that I think about it.
That was a great explanation. I can definitely see the argument for the behavioral side with the limits to arbitrage.
Yeah. And then to just extend that, so another reason why we've gone into more concentrated factors is actually related to kind of a projected bet about the equilibriums of the future. Because factors have become so much more accessible, computing power is everywhere, like at the margin, do you think you're going to get the edge buying the 500 cheapest stocks with a tilt? Probably not. Like at the margin, that's probably been arbitraged out because it's easier to risk manage. A lot of the behavioral and like tracking error capabilities have minimized like the cost of being a quote unquote value person. But I still believe that if you're willing to go into the most extreme, so maybe the whole equilibrium is that every factor earns less excess return than it has in the past, but at the margin, the most pain is going to be in these crazy whack job type focus factor portfolios that we're doing. So I feel more confident that that's more sustainable out of sample than doing these kind of, closet index factor constrained, because I do think at the margin, everything gets arbitraged over time. So that's anyway.
Interesting. So we're feeling the pain now, as I'm sure you know too, with the value premium, particularly in the U.S., not as much in Canada.
Yeah.
What's your take? As you kind of just talked about it. Maybe there's at the margin not a whole lot of premium left in the value risk premium. Maybe there is in concentrated bets. But do you think the value premium's dead? Is it coming back?
No, I don't think it's dead. And I'll tell you why. So why does the value premium work in the first place, at least the theory? So the risk-based theory is, hey, you own a bunch of these crappy companies that, they're crappy. They have shitty economic situations. So they should be cheap because you need to be compensated for owning, the non-Amazons of the world. And so that's theory one. And there's probably some truth to that for sure. That one's harder to assess out of sample. But the other one, which I think is kind of related, is the behavioral theory for value in particular is like it's an overreaction to bad news, right? So value stocks, yeah, they're crappy companies. We all know that. Like these are not Googles. But what happens is the fundamentals come out and yeah, this is a really bad company. But over time, it turns out to be not as bad as expected. And then there's a reversion in estimates about the future of this company, and then you make your little spread, right? Risk adjusted or what have you. And so what happens if you look over the last 5 to 10 years, The problem with value, and this is particular problem with book to market value, is the fundamentals when you bought were crappy. The problem is the realization of the fundamentals were actually crappy. And in some cases, even crappier than expected. So it wasn't a case of people threw the baby out with the bathwater. It's that they actually underreacted to just how bad it was going to be. So I think just value had a fundamental bad role. And that happens. Like, that's kind of the risk part. And then the other component is if you look at, like, a lot of times what you'll do is you look at like earnings surprises. So a value stock will, obviously it's priced as value. Everyone hates it. But then they come out with earnings. They're like, oh my God, it's way better than expected. And you generally get like a boost there because this is news to the market because we need to change sentiment about the stock. And what you've seen is kind of like these earnings surprises and the reactions to them on value stocks that have actually beaten have actually been a lot more muted. And one argument is that, maybe it's just because there's so much passive out there and there's not enough fundamental guys and there's just so much sentiment, like Amazon's going to destroy everyone else is a loser. Even if a value firm comes out with fundamentals that beat expectations, they just don't get that same kind of jump that they used to. And that'd be an argument like maybe the behavioral component has been arbitraged away, or it's just a short-term in-sample situation. And this has happened in the past where fundamentals were actually worse than expected and priced. And when people were winning, at just for whatever reason, you haven't gotten the same sort of boost. Now, I would not bet that would be the same case going forward, because I still believe in human issues and human overreaction to the bad news in like these value names. Because who wants to own like Macy's or whatever? It's just like retail or energy. I still believe that sentiment drives markets, and there's still an overreaction to bad news in the short run that on average ends up being better than expected. So I still believe in the value premium because I think human behavior is still on average going to miss it. And I think the risk is still there. Like, you're going to buy crappy companies. Well, you should get compensated, but it just this in sample, it was a bad run because fundamentals were just really, really bad. I don't know why I would expect that in the future. So I think value is still alive. I just think it's going to continue to be painful.
What a fascinating answer. So market cap indexing is exploding around the world, and certainly in the United States, and you're way ahead of Canada in terms of broad market cap indexing. Knowing what you know about markets and all the studying you've done, do you think it makes sense for anyone, or what would your feedback be to anyone who's investing only in market cap weighted indexing?
So what I'd say is market cap weighted indexing is actually, it's kind of like going back to our hedge fund discussion. It's an amazing solution because it's so cheap, so tax efficient, and hard to screw up too bad, right? And a lot of times in financial markets, like if people have bad advice or people are always trying to exploit them, just doing simple things like owning market, not paying too much fees, not trading a lot, that gets you 99% of the way there. And so for a lot of people, great solution, right? Now, what's interesting is it's also somewhat constraining because you're essentially buying mega cap beta factor if you look at it through a factor lens. And that's fine because you got it so cheap and efficiently, but you've also eliminated a whole world of diversification opportunities. Like you could get value, momentum, quality, whatever it is. There's all these other ways where you can make that portfolio more robust and have more access to more risk exposures. And why wouldn't you take advantage of that opportunity to the extent you could also get those cheap, tax efficient, and create a behavioral setup where you can stick with them. So the long-winded answer to say, for some people, it's probably a great solution. For other people, there's probably more opportunities to add additional risk factors on there to the extent that, they're educated about it, they can access it affordably and all these other things.
So you've written, I've read both your books on quantitative value and momentum. If you had to choose one factor to put all your family's money, bet all your family's money on, what would it be?
I would honestly probably go like global deep value, just because it's easier to manage, doesn't require like tons of trading. And I don't know, I'm more confident in deep value and global, just to keep it diversified, not just US centric. In momentum, it's not that I'm not confident in it. It's just, I don't know if my wife would like to watch a momentum portfolio every day. It's not intuitive. It's just behaviorally a lot more challenging. So I would go with just global deep value, because I know my wife would be like, oh yeah, I get it. Buy cheap stuff and hold it for a long haul. That makes sense. So I feel like behaviorally she would sit in her seat, and she would also take advantage of, capturing beta, capturing value premium, and capture global diversification.
Interesting. So global deep value in a diversified, not a concentrated portfolio.
I would keep it somewhat concentrated, but kind of like with our two indices, you end up, U.S. international, you're probably like 100, 150 stocks. I would want to keep it somewhat concentrated, just so I could actually, ensure that I'm still exploiting, or capturing the value premium. Because obviously, if you have a 100 stock global portfolio, you're going to catch the beta there noisily versus, say, buy everything in the world. But so I want to capture that, but then I want to make sure I'm actually capturing the value factor in a meaningful way. So.
This is my last question for you, Wes, and it's one that we always ask. I think you're super impressive, and for lots of different ways. I think your background is extremely, almost eclectic. From your education to the fact you put your education on hold to serve in the Marines. As I understand it, when you were overseas, you learned Arabic, which made you very valuable when you served in Iraq. On top of that, you're a long distance runner, and I see online you do all kinds of crazy athletic endeavors. So given this whole set, and I know there's a whole lot more to your story, but given this set of experiences, how do you define happiness and success in your life?
There's kind of two elements. Like one is just like, I'm kind of old school in the sense I just like being with my family. And so like I've set up my whole life where like we run our office and our business like out of my house. It's kind of like a compound, just so every night, I get to hang out with my family. Every morning I get to hang out with my family, and I got 3 little kids. So I just get to watch them grow up. So that's really important to me. And for me, that's being successful, like setting up a job where I actually get to hang out with my family every day, opposed to, working 100-hour weeks and my kids don't even know who I am. And then the second one is just, I'm just kind of tribal by nature. And so like, I love the Marines because it's, you hang out basically with your friends each day, and everyone's on like a common mission. And so I tried to recreate that as best I could in like civilian world. So that's kind of what I do now at Alpha Architect, right? Like all my partners, we're all like, it's an owner operator firm. So we're kind of all in it to win it. We're all, friends, like both professionally and personally. And we all have this kind of common mission to, empower investors through education. And so I kind of replicated my need for tribalism and hanging out with the team and being focused on a common mission. So I'm good, man. I don't really have any other complaints. And in my head, I'm successful. So that's all I need, is just be with my family and hang out with my friends and drive towards a common goal.
Yeah, that's awesome. Well, Wes, this has been fascinating. We really appreciate you taking the time, and the answers that you had for our listeners were super insightful.
Yeah, no, appreciate it. And yeah, if anyone has any questions or follow-ups, feel free to reach out. We're super open and transparent, and accessible. You could just send me an email and I'll actually respond. Not a problem.
You were very accessible. You were willing to join us on the podcast with, I think, a simple email from Ben, and we're very grateful for that. And thanks for joining us, Wes, very much.
Yep, you got it, guys. And good luck out there. And again, appreciate the opportunity to be on the podcast.